Hello, and welcome to session 2 from wherever you're joining us today. I'll try and avoid the use of the word unprecedented today, but it goes without saying that credit risk increased significantly in 2020. A dramatic slowdown across all sectors and most countries resulted in some once well-regarded businesses suddenly becoming financially unstable. And despite governments launching unprecedented, use that word already, support measures and general levels of liquidity at record levels, we hear insolvencies are on the rise and managing credit risk has been a key challenge for most companies. Helping us to navigate this area and provide their views on dealing with credit risk in 2021, we're lucky to be joined by two treasurers who have very different backgrounds and perspectives on the market. Hopefully this range of views will provide you with some relevant insights and some actions to take away and apply. Now, again, a bit of housekeeping. Please post any questions on the Q&A tab near the presentation screen. We do have a live discussion forum available. Please do get involved. Sometimes we get some really rich and interesting discussions amongst attendees. A reminder, the site will be available for 14 days after today, so you can re-watch content if you missed it or want to share with other people. And we have on-demand content available on the site as part of our commitment to well-being, and that includes some great soft skill sessions on career development and developing yourself in a virtual world. Also a reminder, you can visit the resources page for more information and materials produced by the ACT and our session sponsor for this third session, Prime Revenue. So before we get going, I want to make some introductions. I'm Naresh Agarwal, and after 30 years working in Treasury, I now provide policy and technical support here at the ACT. I led cash management at PwC, where I undertook a number of projects that manage working capital more effectively and often results in a reduction in risk and an increase in cash generation. And as a treasurer, I was frequently made aware of credit risks, but sometimes only when it was too late. Joining us, we have Afield, who's the Assistant Treasurer Anglo American, a global mining company with a portfolio that spans diamonds, platinum, copper, iron ore, and more, I'm told. And James Piper is an experienced treasurer who founded a specialized consultancy offering a whole market credit overview. Now, most treasurers will be familiar with the idea of counterparty risk, but from my own personal experience, credit risk is a very different proposition. And Aaron, I'm going to turn to you first and give a brief description of your company and your role and why you think treasurers are not familiar with credit risk.
Sure. Hi, good day. Thanks, Naresh. So Anglo American, as you mentioned, is a global mining company. We're very diversified. We operate in 15 countries. We have two substantial marketing hubs in London and in Singapore. We're listed on the FTSE and the Johannesburg Stock Exchange. And with our number one corporate value being safety, that relates in no small way to the management of cash and how we think about credit risk of our counterparties. My team and I in London look after our non-South African treasury activities. That's primarily our debt capital markets portfolio, any FX and rates hedging activities, cash management, and our banking and rating agency relationships. In previous roles, I was responsible for credit risk management in our marketing business, and then after that, the treasurer of that same business. I wouldn't say at all that treasurers were unfamiliar with credit risk. In fact, I think it's probably our bread and butter. I think it's probably just the distinction between credit risk and counterparty risk where I would differ from your views, Naresh. I think credit risk, I think in the eyes of maybe someone who's an asset manager and investing in credit risk products means something very different. And if they're buying a corporate bond with a particular or selling with a particular view on how that credit will evolve, I think that's a very particular lens on credit risk. Whereas I would expect for the majority of us, or those in the corporate space, that it really just relates to getting paid by the counterparties with whom we contract and how we expect that probability to evolve over the life of a transaction, and just the amount of certainty that we'll ultimately have, we're going to get that cash back in the bank. Whereas I think counterparty risk is even bigger than that. It picks up other risks around dealing with your counterparties, whether it's certain reputational or KYC risks that maybe we need to solve, or are you dealing with politically exposed individuals, this kind of thing, which can all impact your business, but may not impact the ability of that other business to pay you. So
I'm just going to interrupt. So we're talking more than just my view around counterparty risk, which is around the banks that I deal with. I have derivatives and maybe a bit of cash with as well. Okay.
For sure. And as I mean, for the credit risk associated with dealing with our banks and monitoring that's bread and butter to Treasury. I think we have a lot to share with the commercial sides of our business if they're not thinking about it in the same way.
Okay, great. James, are you going to side with me or agree with Aaron?
Well, I'm definitely not siding with you, Naresh, I'm afraid. That's the norm, I'm afraid. So yeah, briefly, my name's James Piper. I've worked in Treasury for sort of 20 plus years. I was at Barrett Developments during the last economic downturn, 2008, which was an enormous fun. I became a sort of turnaround treasurer by default, then went to work for 2 private equity firms in their turnaround portfolios, dealing with debt distressed businesses, working capital issues, working with the trade credit agencies and explaining how specifically private equity firms have challenges with statutory accounting rules. They work on an EBIT basis rather than a stat accounting, and there's a disconnect there. 3 years ago, set up Lightbulb Credit. We're an independent sort of boutique consultancy that does review, repair, and monitoring services across the whole of the credit spectrum. I'm siding with Aaron on this in that I think, you know, to look at this in sort of isolation, treasurers sit in a very unique and valuable position in the business, and credit risk is essential. And moving through 2020 as we have done, and the macroeconomic background that we're dealing with, 2021 is going to face, you know, we've got some challenges there as well. So I think credit risk is about certainty of those people you are transacting with, whether they're suppliers, customers, counterparty banks, and monitoring the risks and identifying the risks, and whether that's monetary, solvency, possible acquisitions that you can find in that. I think it's important that there is an understanding that this is everyone's responsibility, and there are processes and things that you need to get in place to have a basic credit risk policy in place. Did that make sense?
Yeah, no, it does.
It's good not to agree with you as well, Naresh.
Okay, well, let me see if I can do better with my next question. And when we were talking about preparing for this afternoon, you talked a bit about segregation of duties, and when I heard it, I thought, wow, I wonder where that's going. Can you tell me how you see that relevant in a credit risk environment? Over to you.
Sure. No, I mean, I think it's another example of a good treasury management principle that can be applied directly to the commercial space. When you think about, just the two players will be your front office, your salespeople, your traders, who are specialized and knowledgeable in creating value and in selling more and in increasing those debtors' positions. But by virtue of that, they will be just increasing those exposures. Whereas you've got perhaps your credit risk team who are on the other side of that. They're the ones who have a deeper specialism in knowing perhaps just how big how much of an exposure is too much, how to contextualize that within the entirety of the debtor's book, how to set and establish limits for counterparties, and whether that's a bit of financial analysis, or whether that's operational risk reviews, meeting with counterparties, understanding their processes. They're the ones who are keeping the salespeople honest, as it were. I think they should work very closely together, mind you. I think credit risk people have a big role in helping to manage the risks that they discover. Whether that's through the suggestions of alternate payment terms, perhaps for certain customers, or leaning on more of the trade finance toolkit, and bringing that to bear to help manage those risks. I think again, credit risk have a responsibility in the ongoing monitoring and reporting of exposures, which role probably doesn't suit your typical salesperson. They need to be out there, selling, knowing their customer, doing their best to maximize value. And so, I think for risk people to be focused on that, to be be managing any sort of governance perhaps associated with those exposures. I think if a very big, very material customer and exposure is on the books, then that probably needs to make its way up to to somebody with a C in their title, I suspect. And so I think it's way for the credit risk team to have an active involvement in managing that. That's not to say that front office are blameless or have no role or just gamblers. I think ultimately front office should be the ones to end up proposing any sort of credit limit for approval through whatever sort of governance process or body a company has. I think they should own it, and their own incentivization should be should be linked to the performance of those credits. I think it's not just enough to sell. You actually need to get the money back in the bank at the end of the day, really, to I think for an incentive program to work. As I say, so I think it's the separation, I think, is important, so that you can allow salespeople to sell, but then risk people to not feel any sort of adverse pressure, perhaps, if they're stopping sales happening when they need to be bringing that safety back to the debtor's book.
So if I just sort of reflect on some of what you're saying, part of what I'm hearing is that sort of classic front versus middle office, or with a sort of controls hat, a sort of first and second line of defense, where, as you say, you've got independent monitoring and a framework, etc., that identifies limits and breaches, etc., but a sort of first line of front office that actually is driving proactively sales or activity going forward. Is that correct? That's
spot on. That's exactly right. Yeah.
And again, just sort of playing on my own reflections, I worked in a treasury function. It was we had relatively well-paid treasury folk, quite good systems, managing counterparty risk with financial institutions. We never lost a single penny. And then we had effectively a production team managing credit risk with lots of very junior people using very basic systems with a very different methodology and analytical analysis compared to what we did. And I always used to think it was quite bizarre that we could lose money on customer sales, and that was actually more hurtful than actually some of my foreign exchange deals.
Indeed.
Is that something in your experience, having spent a lot of time in different places and different roles, is that something you think is still quite a big separation?
I think it certainly can be. I think when we were establishing our marketing business in Singapore about 10 years ago, I think that was definitely something we saw, that there was a myriad of different approaches when it came to measuring those customer risks. And to the point you're making, in a typical treasury, I think we can be in positions where we're taking on quite substantial exposures to our banks, and so that warrants an awful lot of very, very close monitoring and management. I think on the customer side, it really depends on what your business looks like. You could have a very, very diversified customer base with fairly small individual exposures, and that kind of diversification in itself is probably your strongest risk management tool. Whereas you may also only have 5 customers with enormous exposures, and any sort of delay or nervousness around any one of those could really cause you some fear. So I think you probably have a very different approach to those two different spheres.
So, James, I'm going to turn the next question to you. And Aaron's talked a bit about the challenges with some of the large-scale exposures people can have. Can you give us a bit of background around the sort of different types of companies who do assess credit risk that I think you in your role come across on a regular basis?
Yeah, so there are the trade credit agencies. So you've got Experian, CreditSafe, Dun & Bradstreet, Equifax, Graydon being the main 5 in the UK. And then you've got trade credit insurers such as Euler, Atradius, QBE, Coface. I can't remember any more off the top of my head. And these products are all web-based. They're all operating, very well, and they all have sort of pluses and minuses. They tend to take data from companies' house, accounting data, statistical data, sector information, director volatility, and these put it through an algorithm, which is a fancy name for a sausage machine. They turn the handle on all of these hundreds of thousands of companies who file their data, and they produce an aggregated score for that business. Now, the more publicly available information, so the larger businesses with group treasurers, they will file full accounts, full disclosures. There's more analysis. One of the issues here is that we've seen this through COVID-19. The companies were given a 3-month extension. So in December, you normally get 9 months to file your accounts, clearly, but a lot of the December 19 accounts that were just filed in December 20 have just come through into the sort of rating agency's domain. And, some of the impacts that material uncertainty statements that audit partners have put in, because there's a personal liability now for audit partners. So if there is any sort of material uncertainty, it's going in there. That can have a catastrophic effect on credit risk. So, whether you're in the accounts receivable or accounts payable department, you need to be aware of what credit risk is. You need to have a clear policy. And to Aaron's point, you really need to be monitoring that. And it can be done on an exposure basis. And the more diversified your risk, the better. But also when, you as a business and as a treasurer should step outside of your business and look how you're credit assessed. So what does the world think of you? Because I know from working in a turnaround environment where sales was the big number one thing, they used to come and say, we want to go and do some work with this company. And we were called the business prevention office in the end, because you're saying, well, we can do this much. And they're like, well, they want to do £1 million. You're like, well, yeah, but they've got a credit rating of 20K. And, that feels a bit aggressive. So there is a balance between commercial activity and the one word I've underlined here is certainty of payment, because I'd rather not do the work than do it and not get paid. And to your point, Naresh, earlier, Treasury functions, exposures, managing your relationships, making sure your counterparty risk is AAA and your overnights, all that. But I've never worked in a Treasury department where we've lost any money on those deals. I've not had a counterparty go pop on me. And we had significantly experienced people. One of the biggest costs that was going through was the bad debt provision on client sales. So I think, there needs to be an adjustment. And as we go through 2021 with the level of insolvencies, CCJs, winding up orders, and as those government funding CBILS and the bounce back loans become payable in Q2 and Q3 of this year, I think those insolvencies will go up. So using a credit measurement tool such as Experian, DNB, Credit Safe, Equifax, Graydon is invaluable because they're quite cheap, they're quick to deploy, you can monitor, so you can get a daily notification of any changes. But that's only as good as the policy that's implementing it and the communication that's going on from the Treasury team or the wider finance team into the commercial team. And now more than ever, the person with a C in their job title is interested because credit risk is going to cause impacts. Does that make sense, Nash?
Yeah, it does. And I guess part of what I'm taking away from both of you is that, like a lot of things in life, a lot of this is down to communication. That if we've got treasurers and treasury teams out there thinking the only risk to the company is to NatWest or BNP or State Bank of India, they're missing a whole layer of additional risk the company is taking on board. As you said, Aaron, at the beginning, there's lots of other things, reputational risk. But if we're looking purely at making sure my money is protected, when I sell stuff, I can actually collect on as much as I expect to get from it. Treasurers should really be making sure they're engaging with the teams doing this, understanding the methodology. And I'm guessing, whilst it's not about getting a consistent methodology, because as you said, Aaron, sometimes if you've got 10,000 suppliers all with £10,000 of receivable, that's a very different thing to £10 million with one bank. And it may create it. But it's about making sure one informs the other. So I guess we'll come back onto trust and confidence. So sorry, Aaron, you were going to say?
Definitely. I think it's a conversation that's very, very necessary. And I'm conscious we're talking credit risk, but the background here today is working capital. And again, I think Treasury needs to be influencing things like payment terms and, whether we should be going longer or shorter, depending on, on cash position and what that looks like as a whole. So no, I think the need for the two broad areas to be communicating regularly and understand what makes sense for the company, is critical.
And just James, just picking up one point before I forget, you talked about all these rating agencies like D&B, Gradens, etc. Are they all broadly similar, or are there some things people should be thinking about when they decide to use one versus another?
Sorry, Naresh, for jumping in there. They all have their unique algorithm that scores businesses in different ways, and it weights particular emphasis on the SIC code, the where the registered office is, the number of directors, all these small variables, how you pay your invoices, because a lot of that data is now shared by your suppliers, how you're paying them. So if you run an Experian dashboard and you check yourself and go, well, I'm treasurer of AB Limited, I've checked my Experian score and I'm 80 out of 100, therefore I don't think I'm a credit risk. You might be 4 out of 100 with Dun & Bradstreet because they score your business differently, or you've caused something to go wrong in their algorithm that's red flagged your business. So stepping outside of your business and understanding how you are viewed as a credit citizen, what your ratings are across all those agencies, is really useful, because whilst you're judging everybody else, equally there's 1,000 eyes on your business judging you. So,
and actually,
yeah, sorry.
That's a very good point. Sorry, because I remember when I worked at Fujitsu, we were a £8 billion turnover company in the UK, and somebody told me we had a £20,000 credit limit from D&B, and it was because we had three county court judgments for a total of £500, which actually had been cleared. They just hadn't been updated on a register.
Yeah.
And I guess back to the point you keep making, looking at your own score is really valuable, if nothing else, to at least make sure you've got the right score there.
Yep.
But actually, maybe I'm guessing, in terms of deciding who you want to use to help score your creditors, your debtors.
And of all of those systems, Dun & Bradstreet skewed very much toward blue chips and the government agencies. It's a premier brand product. If and it might not be cost effective to monitor 2,000 suppliers through them, whereas Experian and Experian and CreditSafe, they really dominate the SME sort of sector, those sort of smaller suppliers. So perhaps we had two systems when I was in Bregal, a PE firm. We would focus bigger blue chip risk here, and we would use the SME risk down this side, both on the supply and on the other side of the table as well, our customer risks. So I think having a balanced view and having a clear policy, and to Aaron's point earlier around communication, get people on a call. I know you can't get them in the same room at the moment, but explain bit of macroeconomic backdrop, bit about the searches, a bit about where the pain's been caused in the business. Go through an example and go, these guys had 400K credit. There was a notification here that we missed on Experian or CreditSafe. We continued selling them. All of a sudden they owed us 800 because we kept putting stuff out the door, and the sales manager's going, it's going to be fine. Wallop, 800 gone. And then you've got a letter from an administrator on your desk going, you might see 7 pence in the pound, in 3 years' time. That's not where we want to be as a Treasury organisation sat there, because that in turn can materially impact our ability to trade and pay. And this is a working capital conference. This is about cash management as well, and how we pull those levers. So certainty of debt and the receivable and your payable is vital now more than ever. And I keep using that word now more than ever, because it's a challenging time.
Yeah, no, that's really good. That's really good help. And I guess a lot of really useful takeaways for people out there of simple things they can do that don't cost very much money at all to actually implement.
In the grand scheme of things, they're a few £1,000s potentially for managing your exposure book and having a daily monitoring service. It's good value for money. Okay,
very good. So, Aaron, James has given us a good sense of some of the agencies looking at large customer debtor portfolios. I know you're probably dealing with the likes of Fitch and S&P. Could you give us a sense of how your experience differs using them?
Sure. I mean, we ourselves are rated by both Fitch, S&P, and Moody's, and when we can use those ratings on certain of our customers, we will. I mean, the express purpose of I think of their ratings relates to listed debt, and they're there for credit investors in the main, and it's the kind of rating which takes an awful lot of time to manage. They come in twice a year, and it's meetings with management, and it's discussions on business plan, and they're really seeking to form a forward-looking view on our business profile and financial risk. I think it's the key question that they're asking is just, will we be able to service our debt over the next 18 to 24 month horizon? That's for their longer term ratings, and then they've got other ratings for short term commercial paper and the like. So it's that longer term, slightly longer term view and a focus on debt that they have. But that doesn't mean you can't apply it to just the general financial strength of your counterparty. The liquidity assessment is a large part of that rating, and I think that's where you want to look to make sure you're going to get paid. And again, I think the different approaches of the agencies vary, and they'll have different metrics and measures and focuses. But ultimately, it resolves into sort of a mapping of various ratings to a probability of default that you can use and to assess the creditworthiness of your counterparty. It's very useful. It's not many counterparties, admittedly, that we sell to that would be rated. And so we do have to use a lot of the same tools that James was referring to. Equally, a lot of the time there's counterparties that aren't being reported on, and that aren't filing public financials, and so then it's negotiated. It's through the contracting process, getting access to their financials, getting commitments to share those with us on a go forward basis, so we can again just form our own view of how much exposure we think they can take on, or we can take on to them rather. And then at the end of all of that, if it doesn't work out, then we need to look at what are the tools that will help us to keep on selling. Because we can move into the secured term space to enable that. Okay,
brilliant. And then
sorry, just one quick point. If the treasuries are operating internationally, it can be very expensive to go and credit check overseas on this sort of stuff. And some of the larger businesses, the PLCs that we work with, some of their recent refinancing has asked for a trade credit insurance policy to be in place on the receivables, because then there's some certainty of payment. So if you are trading overseas and you're looking to go and have some refinancing, do expect for some level of trade credit insurance where, get a good broker on board and get them to help you with that, because more and more banks are looking for certainty of their of their payments. Sorry to push in there. It was just one that we'd got a live example this morning with a client on that.
Okay, and I think we'll spend a bit of time talking about credit insurance and how it sort of how it changed last year for some organisations. Just picking up on the rating agencies, Aaron, when you're looking at them, what sort of things do you think people should be mindful of? What are some of the mistakes people make?
I think there's not just a single rating from any of them. I think there's this tenors question. I think about looking through the nature of your exposure for the type of rating that they're putting out, perhaps. For example, in the Treasury space, it'd be quite common for us to look at our long-term issuer ratings. If it's if we're hedging a bond, perhaps, and we're going to be exposed to a particular bank for 5 to 10 years. But even then, actually, there's maybe then it's more appropriate to look at the derivative rating of that particular bank, because I think they'll have to service those obligations before they made their debt. But equally, I think if you were using a public credit rating for commercial sales, for example, I think they'll probably be more inclined to look to the short-term ratings, the A1, P1, F1 kind of ratings that you hear put out by those organizations. I think that'd be my advice.
Okay, brilliant. And James, people, I know you've covered some of these points already around looking at the different rating agencies and deciding which ones to look at. What would be your own sort of advice to people listening to this?
I I would, it depends what sector you operate in. It depends on what your level of exposure are and to which businesses. It depends on your appetite to spend money. It depends on which system you want it to integrate, how you want it. Do you want an API daily? Or is it a web-based system that someone just logs in and you receive email notifications? There's the whole variety, and the technology's improved, and the front-end GUIs of these web services are bespoke. You can tailor them to how you want. So I'd encourage people to engage with one or two or three of them and get them in a tendering process. Test the product, see how it works. Speak to your own IT guys about the integration, because from what a sales guy from one of the agencies will tell you is a week's worth of integration, in my experience, tends to be about 3 months. So I'd do some research, speak to other people who are using them. If they've got a client or sector in you that another treasury you can speak to, ask what their opinion is. Which one do they like? What's been valuable for them? Treasurers as a group it's a very collegiate atmosphere. People are happy to share information and their experiences about stuff.
Okay, that's brilliant. So we've talked a bit about assessing and identifying the risks and then monitoring the risks. And I now want to turn to managing the risks themselves. And Aaron, the first question is for you. What tools do you see companies using? And can you tell me about how you see them being used in different circumstances and in different types of companies?
Sure thing. I can definitely do that, and we talk about the array of payment terms and tools that are available. I think because we see various of these terms applied in different commodities in our portfolio. I think the best gold standard is just to eliminate the risk altogether and see if you can get prepaid. It's not common, obviously, but if the nature of the product demands it, and then that's your best route. There's an array of secured payment terms as well. Letters of credit in the main, documentary LCs, standby LCs. The documentary LC is tricky and very document heavy, and it's used as a primary payment mechanism, and i.e. that is the route that you need to follow to get paid. As opposed to a standby LC, which is a bank guarantee, and if somebody falls over, then you need to claim under it. Those are secure payment mechanisms, but they're not removing credit risk entirely. They're just shuffling it around a bit. In the instance of an LC, in the main, it's the issuing bank that you're then exposed to once you receive that from your customer. Again, I think you have the opportunity to assess whether you want to remain exposed to that bank, and potentially there's issues around concentrations or just absolute limits of exposure to that bank. You want to move on, and then you can explore with other banks in your pool, LC confirmation or LC discounting to reduce those exposures. That also has a positive impact on working capital as well. And then, I guess probably, moving to the other end of the spectrum, you're into open account terms. You've delivered a goods or service, and 30, 60, 90 days after that, you're going to get paid, and there's probably a degree of exposure you can live with. But then once it goes too much, I think then you need to think about how you can manage that. I think obvious places to look there are things like parent company guarantees. Is your counterparty part of a larger group? That's whose creditworthiness you can access. Again, I would probably be encouraging folk to get written documented guarantees than relying upon implicit support too much. And then particularly if the entity is a subsidiary as opposed to maybe a branch of a business, a branch you can probably treat as the same. They're legally indistinguishable. If not a parent company guarantee, then it's bank guarantees again. But in both cases, not forgetting that you haven't removed credit risk, you've just changed it. You've gone for that better credit worthiness from the parent or from a bank that's acceptable to you. And then finally, as James referred to, this credit insurance. Again, you could put a wrapper around your entire debtors portfolio. What you have created then is one massive exposure to the creditworthiness of that insurer. And so again, you might want to just think about how does that stack up against your policies? Is that, do you need to diversify that? Maybe you need multiple insurers. to be involved. Yeah, those are the tools that we would use. And as I said, as much as possible, that's all determined up front in the negotiating process with your counterparties. And after the fact, once you're dealing with each other, and if prices moves, if FX moves, and those exposures start to climb, or if a vessel is being delayed and suddenly multiple deliveries are happening within weeks of each other, you can breach exposure limits very, very quickly. Then you can think about things like receivables finance, maybe to sell down your factoring to bring those exposures back down into your acceptable limits.
Okay, super. James, I'm going to ask you about credit insurance, but I've got a question also that is related to it. And this is, in any financial crisis, credit insurance is often one of the first things to change. What tools are available to reduce the impact of this?
I think just a bit at the moment, the sort of credit backdrop, and we made a brief note that credit insurance is a great umbrella when the sun is shining. And I know that's a very broadly used analogy, but I think if you asked a lot of people who'd got policies in place this time last year, whether they still have the same level of cover, I don't think there'll be many nodding to the screen at the moment. So, there's a lot of challenges in there, and it can change very quickly. We had a client that was given 60 days notice that they were no longer going to provide cover. And that was a sector exposure that a particular trade credit insurer had. And they just switched the lights off and went, no, we're not writing any cover there, guys. So how you can manage that, and new ways around that, is you've got to be proactive, engage with the trade credit insurers. You've got to share information. You've got to equally, and my personal preference would be to use a broker in this, because you're paying a brokerage fee, which is the same as you would if you contracted directly. That broker's got access to all the underwriters across all of those insurers. You can firstly share your information about your business to make sure that you're still creditworthy and people are able to get trade credit insurance on you and trade with you. So the inward is still coming in. On the outward side, you can manage your risk through those policies, and a good broker will ensure that they are feeding and gathering quarterly MI from your large credit exposures to ensure that the credit insurer that's supporting you is happy and covered. That's a discipline that, in the two PE firms that I worked in, we started from ground zero. There was nothing there. And it took us 6-9 months to build that muscle memory and the repetition of the data pack goes. This is how it's shared. But now more than ever, while these challenges are being faced to us, building that discipline in and allocating that role to someone about gathering and sharing and making sure the trade credit insurance market is aware of your business and the businesses you work with. If you're not getting cover now, you'll be first in the queue when they start writing cover, because these things are cyclical and the product may change somewhat. Credit insurance may evolve slightly. I'm not sure what that'll look like yet. I think there's quite a few trade credit insurers sat there scratching their heads. I think my earlier point about how it's being linked to funding and financing and the certainty that the bank want on the back of that is directly linked to availability. And if there's no trade credit available, you can't be restrictive on the finance, but you'll probably end up paying a higher premium through the margin. So I think just being a good corporate citizen, being diligent, proactive, and having a process and strategy. These trade credit insurers are underwriters, whatever you want them to be. They don't mind if you share with them some bad information. If there's a story to explain it as to whether it's COVID or there's been a sector downgrade or a large contract's gone over, it's when you go dark on them and you disappear, they become very squirrely and very nervous. And we've seen that through 2020, where large insurers have just removed themselves from either sectors or companies because they've got huge exposures into this. Did that answer the question, Ash?
Yeah, so I guess part of what I'm taking away then is, again, this is about communication, but also interestingly, I can actually potentially influence how a credit insurer may view me if, as you say, I've got a sensible and coherent story to tell.
Absolutely. It's all done under an NDA. And I understand if you're a PLC, there's more challenges with that, you know, with the financial disclosures. But there are ways around it. So yeah, engagement, honesty, explanation, and frequency. That's just build that muscle memory into the team, because they are so vital to you, and now more than ever, they want to see information.
So we've talked about organizations. I think, Aaron, you mentioned a few that, well, first of all, we talked about organizations that are rated. There are, I guess, organizations that aren't rated. For those that aren't rated, I'm going to ask this to you, James. From your experience, is there a default position that says you're, I know, however big you are, it's going to be no more than 10 grand, or I know, an equivalent of a BBB long-term rating? And also, can I ask to be rated?
With the trade credit agencies, previously, if you didn't like your rating, and this is how I got into this, is I sat in a room with two senior guys from Dun & Bradstreet, and when you've got me 4 out of 100, I'm in a business that generates £7 million of cash, and it actually states a statutory accounting loss of £7 million. Here's the difference. There's a previous amortization of an investment. Yeah, there's a load of depreciation. We've written off some goodwill, and there's some loan notes which are actually non-cash. So it's a P&L charge for the private equity investor. We bridged it back, and they went, so you make £7 million a year? I was like, yeah, and you're currently giving me a 0 recommended credit limit, where I'm on pro forma, and actually look at my bank balance. I'm pretty good. So it's through that process of engaging with the agencies and explaining those things, because the information that's held at Companies House is actually correct, accurate. It's not the most timely because of the lag that we've got, especially accelerated at this point. But there are ways of explaining your business to get a better credit profile, which is you know why I left corporate treasury and do what we do now. It's quite a simple process. There's complex elements to it, like there is for anything. But yeah, you can certainly challenge your rating, and you know, there is a default position, especially those SMEs businesses that we deal with who haven't got a corporate treasury function because the MD or the FD has to wear several hats. You know, they file exempt accounts, so it's just a balance sheet. You can make a balance sheet look like anything at any point in time. And you know, there's a classic example. We had a client who, specialist oil and gas manufacturing business, £12 million turnover, 6-year order book. His sister-in-law was the company secretary. She filled out his company confirmation statement, and she got all the right numbers in the wrong order. And he was classified as a rice grower in Bromsgrove. His credit rating went from 250,000 to 0. We challenged this with the specific agency, and they put it back in place 72 hours later. So an SIC code, some you know, filing anomaly like that can really impact a business. It's just a small example of how these things are. You know, you can go from 0 to 100 very quickly, and vice versa.
And I guess part of what I'm taking away from today, and we've seen it as well from last year, is that rapid change can have a really immediate impact on your working capital. If people start to say, actually, I think you mentioned it earlier, if you were previously on 60-day terms and you're now on almost cash on delivery, that's a huge and really immediate requirement to fund the business.
And going back to Aaron's point earlier around and topco and parent company guarantees, you know, in the private equity companies I worked in, the debt and the loan notes were in the topco. So the topco had far poorer ratings than the opco. So we had challenges in that. It didn't actually work. It was counterproductive and counterintuitive, because that's where the debt was, and the negative huge net liabilities on the balance sheet would sit. Private equity would call it quasi-equity, but it's in the debt portion of the balance sheet, let's be fair. So I think, you know, can you just repeat the question for me, Naresh? Sorry, I went off on a tangent there.
It was more just the fact that the speed with which your credit rating can change and the impact it has on your liquidity can be pretty big and pretty dramatic.
Apologies. If you have significant credit limits in place for your business, and there's a material adverse impact, and you've got an audit qualification. I've sat in the room where we've gone from being on 30, 60 and 90 days with some large OEM suppliers, credit ratings being cut, and they're going, not only are we not delivering the stuff that you've ordered, but you've also got to pay us all of that amount of money. It's a fairly unpleasant call to go on, especially with a private equity investor, and go, sorry, Giles, you couldn't write me a check for 8 million, could you? And it wasn't in the cash flow. You tend to lose a bit of credibility if if you're having that conversation. So how much you rely on your trade credit terms and your credit ratings, as I say, a single day and the filing, we had a client move from 1.5 million of recommended credit down to 0 based on a CCJ, to your Fujitsu example. So understanding and managing that risk is a challenge.
Okay, excellent. So I'm going to sort of speed through some of the other questions because we've got some questions from the audience as well. This one for you, James. A lot of people may be relatively novice to the field of credit management. Where could and should they be going for more information?
If you trade credit insure, use your broker. They've got access to a lot of information. Your bank, as always, speak with the various agencies, arrange a call, log on. They've got demonstration sites. They're keen now more than ever to sell their products and services. There's a variety of webinars and journals. The Credit Management Institute are very good. ACT, of course. I mean, I'm a big banger of the drum now, been qualified for 14 plus years or whatever. It feels a lot longer. But speak to your peers. Speak to people who work in different industries. LinkedIn connections. There's a whole variety of places where people, whilst they can't get into specifics around certain exposures, they'll talk about the tools they use, the suite of services they use, their policy in general terms. So it's a very collegiate atmosphere. So use the Treasury organisation.
So you talked about this. It sounds like there's quite a lot of organisations out there that are willing to help if people, I guess, have got the right questions or want to go and learn more. Aaron, what's your own experience? I mean, I sometimes worry that banks are there just trying to sell another product. Is that something that should put me off going to talk to them?
No, I mean, they are. I mean, it's kind of the space we live in, right? We need them and love them, but we know that there's good money in it for them. So treat it like any sort of advice that you need. Consult widely, test that advice. I would echo everything that James has said. I mean, the big agencies, I know Moody's is regularly doing credit analysis 101 courses and seminars, that kind of thing. That's a great way to increase your knowledge. Also spend some time just learning about that toolkit, that trade finance toolkit, doc LCs, standby LCs, bank guarantees. What are the pitfalls? When do they work? When don't they work? I would consult all of that.
Okay, so I'm going to go back to one of the points you made right at the beginning. This is a question from the audience about sales versus treasury, and I'm going to summarize it. But effectively, other than just having a policy in place, what do you think Treasury can do to actually step up the influence into the business? I'm going to ask you, Aaron, on this.
Sure. I think it probably does start with policy. I think in our organization, and I would be an advocate of the same, that the Treasury would own bank risk. So to the degree that maybe in managing your credit risk or payment terms overall, where you're relying on trade finance terms, or that Treasury would be the ultimate owner of those bank risk exposures and defining those. But then it moves into the non-financial space and your customers, and I think that's where I think Treasury probably has less of a direct role, but much more of an influencing role. I think such that people are understanding the cost of cash for the organization. That if payment terms are being negotiated and they're moving shorter or longer, what the ultimate cost or benefits of that are. If the company doesn't have its own credit risk function, I think then maybe it's up to Treasury then with that view of the criticality around cash, that to define what maximal limits look like for certain types of customers. And for Treasury to have a seat at whatever sort of risk committee or governance there is to determine what those maximum exposures look like. I think the commercial side of the organization might be charging ahead, and so maybe it's up to the treasurer to be that sort of the quieter, saner voice in the room to say, but what if, folks? What are we going to do to manage that? What happens if it goes wrong? Because again, to the point that's been made many times, if we do have a significant failure on the debtor side, it will impact our own financial performance, and we're the ones who are going to bring that voice into the room.
So I guess part of what I'm hearing there is we have a legitimate right to be in the room, because we know that financial default on some of our customers will have an impact either on our cash forecast or on some of our cash balances, or a direct impact on the work we do.
And that might be indirectly equally. I think it's we perhaps on the Treasury side, maybe we've secured some finance if it's secured by to the debtors pool, or whether it's invoices or LCs that have been linked to that finance. The performance of those is then critical to our ability to continue to finance the company. So a huge right to be a part of that conversation.
Okay. And James, what's your how and what role should Treasury play, as well as just writing a policy?
I think definitely included at the top table of those conversations. And I think engagement, understanding, and what we did at one of the Bregal investments was the sales guys, before they came to bring us a new prospect, they'd actually credit vetted them. And then once we did an afternoon session in a pub when you were able to go to pubs. And they were able to go back and say, look, we'd like to work with you, but we've got a problem. It's either we can't get trade credit insurance. Are you sharing data with a trade credit insurer? Do you trade credit insure? And you've actually got sales guys who want to, they're incentivized to make the sale. If you give them the skills and the tool set and the explanatory ways that they can assist a sale by talking to them, who's working with you? Where's your bank? Well, your Dun & Bradstreet score is not very good. Your experience score. So what's the blocker to the sale? Is it trade credit insurance that you can't get on them? Or is it company's own internal policy where they've done a credit assessment and there's a limit put in place which isn't sufficient? So identify what the issue is, and then explain to the commercial and sales guys how they can help their potential client, with those issues. That was really useful for us at Bregal, really useful.
And in fact, one of the things that I can share from reviewing some of our ACT cash management material, one thing I read was that actually, if we can help improve the credit score for our customers, that it may be that what was a 50 grand limit can actually now be a £500,000 limit. And actually part of what I took away from that is we can say to the sales teams, actually, this isn't just us, as you refer to it, James, as being a break on the business. Yep. If we have a more engaging dialogue, we can maybe help you sell more if we're more comfortable with a methodology around how you're actually assessing credit risk. So I guess there's a practical element to what we can actually help them deliver more.
And I think it breaks that sort of the mindset of people who just go, I'm not asking them, they'll just say no. You're actually giving them a solution and a set of tools and some understanding of what the issue is, why you've said no, and how they can help fix it and turn it around. I think once you give people that, you engage them, firstly, your credibility goes up and their engagement goes up. But equally, they only need to get one or two deals across the line and move a limit from 50 to 500K. They see that bonus come through. They're well on side with this now.
Okay, and the only other one I'll add from my own experience is doing a bit of cross-training. So one of the things that I found useful is having somebody from the credit team spend a couple of weeks in Treasury, and for someone in Treasury to spend a couple of weeks in the credit teams. I've always found these sort of exchanges can only ever benefit how people understand things. I'm gonna draw a line on that question just because I've got a couple of others that I really want to get to. Innovation in the sort of credit space, and again thinking about it from a working capital perspective. Blockchain's an obvious thing. Are we seeing some DLT solutions helping manage credit risk and help accelerate manage working capital better? Aaron, I see you nodding.
Sure. No, where I've seen it has been in the trade finance space. Products such as Comgo and was called Voltron, now called Contour, using blockchain to issue letters of credit, taking very documentary heavy processes which move around multiple hands all over the world, and doing things in the electronic space that would over the course of a day that might have taken 10 days previously in a super secure manner. I think there's still some strides to be made in terms of the full dematerialization of bills of lading and this kind of thing. But I think it's in slow adoption still, I believe, but I think a great step in the right direction.
And are you saying you're seeing people actually transacting and using this as part of their, not as a pilot, but actually as part of their BAU?
It's starting to, yes, I do. I mean, it's still in the bulk space, iron ore trading. We are seeing it. It takes a lot to get established and to get you and your customer on it, and to know that all the various stakeholders in the value chain are on board. But that's increasing slowly.
Okay.
And I think the benefits associated with it, and I think ultimately it's the security and the reduction of working capital associated with trading, I think will mean that it should win in the end, but just there's some hurdles to get over still.
Okay. James, any sort of thoughts on any other innovations as well as blockchain that you're seeing?
No, I mean, we started an innovative business to sort of challenge the ratings, and been sat in sort of the Treasury's chair, going, why am I rated at 4 out of 100? This isn't fair. So push the boundaries, challenge things. We came across a business about 2 weeks ago or so called Red Flag Alert, who are being used by a lot of financial institutions they've got a very high success rate in an algorithm that's able to forecast insolvencies. And there's tools like that. There's constantly new fintech technologies in this, whether it's, Aaron mentioned PPEs earlier, and that sort of personal checking and the diligence and the sort of compliance piece. There's really good tools around onboarding customers, clients, businesses, and in-country products. Your trade credit insurance broker as well, they're coming out with new innovative solutions to help you source finance and funding, get better advance rates. So just pick up the phone, and they want to come and talk. They want to sell you something, but they will impart some information on you as well. Okay,
super. So last question from the audience. What is one of the most challenging cases of credit management you've worked on in your Treasury career? And what was the key learning point from that? You've got about a minute each on this.
Can't name names, but had the wrestle that was spoken about, where the credit limit was here, but we wanted to sell here, and it was a great collaborative effort in allowing a little bit and letting them perform, and then getting comfortable to keep on increasing. And I think just demonstrating the value that credit risk could bring to the negotiations. That was mine.
And James, 30 seconds.
So mine was a while back now, but it was on the flip side. It was actually our company's credit rating that was prohibiting us from actually tendering for large government contracts. In the tendering process, there was a hurdle. We were below that, so we had to actually get our rating over the hurdle, and that was a to and from between the agency, ourselves, commercial, finance, and we got it across the line in the end. And the rewards for actually being able to tender and win work are huge.
Okay, so we've got a couple of minutes left. Can I ask you just to share some thoughts around credit and working capital for 2021/22? James, you first.
Yeah, so people are probably expecting the doom mongering of everything's going to go wrong, and C-bills, the bounce back loans, insolvency, CCJs, and that's true. But I think you'll also see there was a huge dump of liquidity into the market through the government backing. It wasn't used to improve supplier terms as they hoped it would. So creditor stretches actually marginally increased. Therefore, there's a lot of businesses holding liquidity. Now, that gives them, firstly, cash to get through the pandemic, but also those businesses that are struggling, there will be acquisitions. Some will go into administration, but they will be bought out of admins, pre-packs, owner entrepreneurs who wish to exit because the multiple's right for them at this point, or they just want to get out. So I think there'll be quite a lot of merger, acquisition, buyouts, defaults, but where there's risk, there's opportunity. And I think if you view it in that, I certainly view 2021 as a time where, yeah, we face some risk, but there's also opportunities.
So a lot more complexity and a lot more need to manage credit risk and have tools so that, bring it back to working capital, we don't take a big working capital hit. Okay.
Yeah, the classic example is if you've got an assumed 45 days, if you've got a cash flow forecast running off your balance sheet and you plug 45 days in as your payment terms, and all of a sudden that changes to zero, I don't think there's a treasurer on this conference now that's not taken a big gulp and gone, that's not going to be good. It's going to hurt. And that can happen, you know, so understand and manage your credit rating.
And Aaron, 60 seconds.
Echo those sentiments. I would just add, you know, test your assumptions. I think it's going to be a tough year for many sectors and industries. If you've been relying on luck in the past, maybe now's the time to think hard about that. Maybe against this backdrop is the time to marshal some resource, you know, time and cash to spend on managing credit risk a bit better.
Okay, super. Well, we're pretty much reached the end of our time. I hope everyone that with the help of James and Aaron, you've learned a lot more about this topic. I think why it's really important for the Treasury community to engage with the rest of the organisation to manage that credit risk and to protect working capital. A quick reminder, discussion forums available on the platform. Do get involved. Everything will be available for 14 days after the event, so do rewatch. So you can rewatch the content we'll share with colleagues. There's quite a lot of content available to download, especially around the soft skills. Do check the resource pages provided by the ACT and Session 3 sponsor, which is Prime Revenue. The only thing I can do is to say thank you, Aaron, James, for supporting this event. It's been really interesting. I really enjoyed learning more and some of the practical takeaways, which hopefully people can go away and start thinking about tomorrow. Thank you.